Good morning, YouTuber family. Jonny Cashflow here. Hope you're doing awesome. And if I don't see you, good afternoon, good evening, and good night. Glad we were able to connect on this most joyous of occasions. So today I wanted to welcome you to Investors for Dummies, Investing for Dummies. I can't even say that right. Anyways, I want to break the things down in this video as simple core principles as possible. There are so many YouTubers, so many gurus, so many financial experts that go into so much of the minutia of all the details without having the understanding of the foundation first, right? So I like to think of any investment. Let's look at stocks as simple as risk versus reward. What is my downside? What is my upside? Right? Okay, what does that mean? Okay, so what that means is if I'm looking at a stock and that stock is trading at $10 and I research it, everything that I'm seeing should be relatively good news about the company. And in fact, all I'm seeing in terms of, precipitous catalyst type events is good things. Oh, in 6 months, this is going to happen. In a year and a half, this and that is going to happen. And if anything, it's only going to give pop to the positive for this, for this stock. So when I look at it and I say, okay, this $10 stock, I don't think this $10 stock, based on my research, is going to go down more than 5%. Okay, what do you think the stock is going to go up? Well, you research that, you research the upside, you research what different analysts might say, different metrics. Again, I'm not a financial advisor, a licensed financial advisor. You should speak to one of those in your own life. I know I do. I speak to financial advisors. Everybody should speak to a financial advisor. But I'm just giving you my perspective based on my experience in big business and investing personally that I think can help to simplify the minutia and the difficulty that people see in getting started. By the way, best investing tip I'm ever going to give you is just start. Take whatever you have. Take $1, take $10, take $100. Go buy SPP, throw it in the market, start. Because the biggest hindrance to somebody being financially independent is starting. So please start, like right now. Like, just pause this video real quick, go on Charles Schwab, and open up a trading account, or Chase, or they all do it now. It's ridiculous. Or go on Webull. I don't care. Like, I don't even have links for this stuff. I'm not promoting any particular. Just go. Just go. Start investing. That'll be the best advice. But now when I look at, let's go back to our $10 theoretical stock. I think the stock has a downside potential of 5%, but I look at it and I'm like, ooh, it's juicy, man. It's looking like in the next 2 years, this thing might pop 50%, might be $15 stock. Okay, so what am I looking at? What I'm looking at is a simple odds game, a simple horse race with 10-1 on my money. How's that? Well, one could argue I'm only feel like I'm risking a 5% downside potential, but I see a 50% upside potential. That's a 10-1 risk on the reward that I could get. If you talk to any odds makers and you can sit at a you're not going to sit at a craps table with 10-1 or whatever, or not a craps. You're not going to the roulette wheel. It's 1 in 64 or whatever it is. Yeah, you're not going to get those types of odds, but you can get those types of odds if you're well researched in investments and in the stock market. Now, here's the tricky thing to remember: you can buy that $10 stock, and then even though everything you researched told you, oh man, I'm gonna be so rich because I got I got 10x on my money. I'm only risking a 5%. I'm going to get that $15. Okay, well, the truth of the matter is it can go to 50 cents in a month because it turns out that the CEO took all the money and went to Singapore and never came back. And the money and the company suddenly became a penny stock. Best laid plans of mice and men often go awry, where suddenly you lost 95% of the principal, and that goes to a question of being diversified in your analysis of risk versus reward. But those are the basic tenets of what you're looking at. What is the risk? What is the reward? What is my risk tolerance? Right? And now let's do this with a real stock, because I'm interested in some Disney right now, boy. Check out that Disney, boy. Check out where that Disney at. Where that Disney at? You see that? That's a 5-year on Disney right now. Currently trading at $79.90. Not a bad time to start cost averaging into this bad boy. The peak of the Disney stock was dang near 200. It's 190. 190 on March 5th, 2021. So less than 2.5 years ago, it was 2.5 times the value. Now, if you actually do some financial analysis, you look into the fundamentals, they do have a lot less cash flow. And so if you understand how companies are evaluated, if a company has half as much cash flow, free cash flow, then they're worth half as much, because many analysts, when they value a company, they give a multiple of the amount of free cash flow that a company has. So if Disney, and I don't know the numbers exactly offhand, but if Disney has $1 billion of free cash flow, and you're saying a comparable company, entertainment company in that space, maybe they get 10x multiple on their free cash flow, well, then that $1 billion in free cash flow is a company that would be worth $10 billion. So that's the basic concept. And like I said, there's been a lot of downward pressure on the cash flows in Disney. So, what it cutting in half there might be fundamental reasons to make an argument that, yeah, fundamentally Disney is not worth more than $90 right now. And maybe that's true. But I'm also not as big into day trading. I will interview day traders so you can get that perspective as well. Again, I feel like so much in the economy and mindset, there's the Robert Kiyosaki, there's the Dave Ramsey, there's the different perspectives on what makes the most sense. But when I look at where Disney is at now, it's below $80. I was saying like 2 weeks ago, and it was like closer to 90, that I was like, man, if that thing drops below 80, it's such a buy. But here's the thing. Let's do the same analysis. Right now we're at $79.90 on Disney. Let's say it drops another 20%, which would, in my estimation, that would be a substantial drop, even though all the news coming out about Disney right now is bad. They need to invest more money into the parks. They need to invest more money into the subscribers on Disney. They need to squeeze the customers that they have and hopefully not lose them, because they need to increase the price of their subscription service on Disney. I mean, this is all just like bad news in the last like few months. But is it bad news? Like long term, if you're a day trader, it's bad news unless you're shorting stock. But long term, if you like Disney, if you think they're going to invest like crazy in their parks in the next 10 years, but then they're going to quadruple their revenue from it, from the extra, so if you believe in the vision, it's debatable whether it's fine for Disney to sacrifice some of their short-term free cash flows in order to dominate a market, in order to dominate amusement parks, in order to dominate live streaming, right, by joining ESPN, Hulu, and Disney. So a lot of interesting moving parts with Disney. Still may be a lot of bad news in the next year. It might drop. 10, 20, 30%. 30%? Do I really believe that? Let's see. $80 minus 30% would be 24. No, I don't think it's possible for Disney to drop 30%. Do I think it's possible for it to drop 20% down to say maybe $60? Oh, absolutely, especially in the next 2 or 3 years where all the stocks are going to get bludgeoned. So yeah, Disney might drop 20%, so it drops to $60. So what we're looking at from 80 to 60 is a 25% drop. But here's the dirty secret, okay? On the flip side of that, if it just gets anywhere near its highs, if it just gets back to 160, that's a 100% increase. So even though I do have a 20% downside potential, my upside, I have 100%. I have an opportunity to double. And again, this question goes to, risk threshold. But when you have something where fundamentally you're arguing that I can get 4-to-1 on my money, 4-to-1 on my risk to my reward, I think that's a buy, or 5-to-1, right? So if you can look at what the downside risk is, what the upside reward is, and then know your risk tolerance, you can make a lot of evaluation and a lot of decisions about what you want to be investing in. So I hope that was insightful. I hope that helps as you guys start to decipher business and stock analytics and investment processes and how your brain should start to think about those things. I'm sure there's a lot of day traders that might have slightly different mindsets. For me, I'm sure there's a lot of long-term traders that have a lot of more granular strategies that we'll go into in future videos. But for anybody, whether you're the expert or the beginning novice, it's really important to understand this concept of risk versus reward. And if you liked this video, you are going to love the video on why I did the entirely counterintuitive thing of selling my property in South Florida that had a 2.5% interest rate. So you can check that out right here. All right, here. Is it going to come up? Oh, there it is. Usually it works. Do a little Thanos snap next time, All right. Y'all have a good one. Much love. We'll see you guys on the next one.